If the market capitalization of an index increases from 18,800 lakhs to 42,500 lakhs and the base value is 100, what is the new index value? Here are your options. A. 226.6, B. 225.0, C. 210.50, or D. 200.0. Take a moment to pause the video and decide. The correct answer is option A. Let's see why. The new index value is calculated as 42,500 divided by 18,800 multiplied by 100, which equals 226.6. In a price-weighted index, if the sum of the stock prices on the base day is 250 and the current sum is 510, what is the current index value? Here are your options. A. 102, B. 250, C. 204, or D. 510. Take a moment to pause the video and decide. The correct answer is option D. Let's see why. The current index value is the sum of current prices, which is 510. Let's tackle this exam question. An equal weighted index has a base value of 100. If the total current value of stocks is 1,46,000 and the base total was 1,20,000, what is the new index value? Here are your options. A. 121.67, B. 120.0, C. 130.0, or D. 110.0. Take a moment to pause the video and decide. The correct answer is option A. Let's see why. The new index value is computed as 1,46,000 divided by 1,20,000 multiplied by 100, which equals 121.67. Test your knowledge with this one. A futures contract is traded at Rs 22,250 with a lot size of 25. What is the contract value? Here are your options. A. Rs 22,250, B. Rs 5 lakh, C. Rs 0.6 lakh, or D. Rs 5,56,250. Take a moment to pause the video and decide. The correct answer is option D. Let's see why. The contract value is calculated as 22,250 multiplied by 25, which equals 5,56,250. Here is another practice question. If a trader takes a long futures position at Rs 22,250 and the contract closes at Rs 22,380.70, what is the daily gain per contract if the lot size is 25? Here are your options. A. Rs 1,468, B. Rs 1,500, C. Rs 1,250, or D. Rs 1,000. Take a moment to pause the video and decide. The correct answer is option A. Let's see why. The daily gain per contract is 22,308 minus 22,250 multiplied by 25, which equals 58.70 multiplied by 25, equaling 1,468. Here is another practice question. A broker requires an initial margin of 10% on a futures contract valued at Rs 5,56,250. How much margin is required? Here are your options. A. 50,000 rupees, B. 55,625 rupees, C. 60,000 rupees, or D. 62,505 rupees. Take a moment to pause the video and decide. The correct answer is option B. Let's see why. The initial margin is 10% of 5,56,250, which equals 55,625. Here is another practice question. In a forward contract for 10 grams of gold, if the agreed forward price is rupees 62,337 and the spot price at delivery is rupees 62,700, what is the profit per 10 grams? Here are your options. A. Rupees 363. B. Rupees 400. C. Rupees 237. Or D. Rupees 500. Take a moment to pause the video and decide. The correct answer is option A. Let's see why. The profit per 10 grams is 62,700 minus 62,337, which equals 363. Let's tackle this exam question. If a share is trading at rupees 100 and the cost of carry is rupees 4 due to interest and dividend, what should be the break-even futures price? Here are your options. A. Rupees 98. B. Rupees 100. C. Rupees 106. Or D. Rupees 104. Take a moment to pause the video and decide. The correct answer is option D. Let's see why. The break-even futures price is the sum of the spot price and the cost of carry, which equals 104. Here is another practice question. To buy 1500 shares, the ideal price is rupees 9.85. If the actual average price paid is rupees 9,09,333, what is the impact cost percentage? Here are your options. A. 0.84%. B. 1.0%. C. 0.75%. Or D. 1.25%. Take a moment to pause the video and decide. The correct answer is option A. Let's see why. The impact cost is calculated as 9,933 minus 985 divided by 985 into 100, which equals approximately 0.84%. Test your knowledge with this one. A stock has a tick size of 5 paisa. If the price moves from rupees 100 to rupees 101, how many ticks is the movement? Here are your options. A. 5 ticks. B. 100 ticks. C. If the price moves from rupees 100 to rupees 101, how many ticks is the movement? A. 20 ticks. Or D. 25 ticks. Take a moment to pause the video and decide. The correct answer is option C. Let's see why. The price change of rupees 1 equals 100 paisa and divided by 5 paisa per tick equals 20 ticks. Test your knowledge with this one. In a long futures position entered at rupees 100, if the price at expiry is rupees 150, what is the profit per unit? Here are your options. A. Rupees 50. B. Rupees 100. C. Rupees 150. Or D. Rupees 30. Take a moment to pause the video and decide. The correct answer is option A. Let's see why. The profit per unit is the difference between the expiry price and the entry price, which is 150 minus 100 equaling 50. Let's look at this next question. In a short futures position entered at rupees 100, if the price at expiry rises to rupees 150, what is the loss per unit? Here are your options. A. 30 rupees. B. 100 rupees. C. 150 rupees. Or D. 50 rupees. Take a moment to pause the video and decide. The correct answer is option D. Let's see why. The loss per unit is calculated as the entry price minus the expiry price, which is 100 minus 150, equaling minus 50. Here is another practice question. On day 1, 50 contracts are added to open interest. On day 2, 100 new contracts are added. What is the total open interest, assuming it was 0 initially? Here are your options. A. 150. B. 50. C. 100. Or D. 200. Take a moment to pause the video and decide. The correct answer is Option A. Let's see why. The total open interest is the sum of the new contracts, which is 50 plus 100 equaling 150. Test your knowledge with this one. If the previous closing price of a contract is rupees 100 and the price band is 10%, what is the upper limit of the price band? Here are your options. A. Rupees 105. B. Rupees 90. C. Rupees 110. Or D. Rupees 115. Take a moment to pause the video and decide. The correct answer is Option C. Let's see why. The upper limit is calculated as 100 plus 10% of 100, which equals 110. Let's tackle this exam question. In a calendar spread, if the near month contract is sold at rupees 150 and the far month contract is bought at rupees 145, what is the net gain per unit? Here are your options. A. Rupees 5 gain. B. Rupees 5 loss. C. Rupees 10 gain. Or D. Rupees 10 loss. Take a moment to pause the video and decide. The correct answer is Option A. Let's see why. The net gain per unit is the difference between the near and far month prices, which is 150 minus 145 equaling 5. Moving on to the next one. A futures contract has a contract multiplier of 25 and a tick size of 0.5. If the price moves by 3 ticks, what is the monetary value of the movement per contract? Here are your options. A. Rupees 5.0. B. Rupees 3.0. C. Rupees 3.75. Or D. Rupees 2.50. Take a moment to pause the video and decide. The correct answer is Option C. Let's see why. The value of the movement is calculated as 0.5 multiplied by 3 multiplied by 25, which equals 3.75. Here is another practice question. A trader borrows rupees 100 at 6% per annum to buy a stock and expects a dividend of rupees 2. What is the net cost of carry for 1 year? Here are your options. A. 4 rupees. B. 6 rupees. C. 2 rupees. Or D. 8 rupees. Take a moment to pause the video and decide. The correct answer is Option A. Let's see why. The net cost of carry is the interest cost minus the dividend, which is 6 minus 2 equaling 4. Moving on to the next one. If the price of a stock increases by 20% and its original weight in an equal weighted index is 25%, what is its contribution to the index change? Here are your options. A. 25%. B. 20%. C. 5%. Or D. 10%. Take a moment to pause the video and decide. The correct answer is Option C. Let's see why. The contribution is calculated as 20% multiplied by 0.25, which equals 5%. Moving on to the next one. If the daily mark-to-market gain per contract is rupees 1,468 and a trader holds 3 contracts, what is the total daily gain? Here are your options. A. Rupees 4,404 rupees. B. Rupees 1,468 rupees. C. Rupees 3,000. Or D. Rupees 5,000. Take a moment to pause the video and decide. The correct answer is Option A. Let's see why. The total gain is 3 multiplied by 1,468, which equals 4,404. Test your knowledge with this one. In a market, if a trader sells 5 contracts and later buys back 2 contracts, what is the remaining open short position? Here are your options. A. 2 contracts. B. 3 contracts. C. 5 contracts. Or D. 7 contracts. Take a moment to pause the video and decide. The correct answer is Option B. Let's see why. The remaining open short position is calculated as 5 minus 2, which equals 3.